Garmin just delivered record-breaking results again. From aviation to fitness to marine tech, every segment grew double digits in Q2 2025. They raised full-year guidance and are pushing deeper into innovation with MYLAPS acquisition and next-gen wearables. We break it all down in today's episode of Know What You Are Investing. Magnifying glass, what they do. Rocket, how they grow. Bar graph, why it matters.
Welcome to Know What You Are Investing, where we decode the world's top companies.
Of they do like?
How they grow.
Well, why it matters.
In this deep dive, we plunge into Garmin's Q2 2025 earnings and a full review of their record-breaking 2024.
Yeah, quite a year for them. And the momentum seems to be carrying through.
Exactly. From a $6.3 billion year in 2024 to a Q2 that beat expectations across every segment, Garmin is proving that innovation in wearables, aviation tech, and outdoor navigation still has plenty of room to run.
It's a fascinating story of specialization and consistent execution.
So let's break down the growth, the guidance, and the strategy behind one of the most, quietly consistent tech performers on the market.
Sounds good. Where should we start? 2024.
Yeah, let's really unpack Garmin's incredible 2024 first. I mean, it wasn't just a good year. It was truly a year of record growth across the board.
Right.
When you look at their annual financials, their total revenue climbed to a new record of $6.3 billion. That's a significant 20% increase year over year.
And what's really striking, I think, is that this wasn't just overall top-line growth.
No, exactly. They actually achieved record revenue in every single one of their segments, all 5.
That's pretty remarkable.
Yeah.
And what's truly insightful here is how that broad growth translated directly into their bottom line. Their gross margins expanded to a very healthy 58.7%, and operating margins reached 25.3%. I mean, this led to a record operating income exceeding $1.5 billion.
Which is huge.
It really is. And this isn't just about selling more units. It points to Garmin's unique pricing power.
That's a great point.
They're not stuck in some kind of race to the bottom on price. They're commanding higher margins because their specialized, innovative products are genuinely solving problems for customers.
Right.
In ways competitors, maybe aren't focusing on. It allows them to turn that growth directly into superior profitability.
That's a key distinction, isn't it? And it's not just price magic either, like you said. They're selling more units, too. Total units delivered jumped by approximately 15%, from about 16.2 million in 2023 up to 18.6 million in 2024. So they're getting more products into more hands.
So volume and value.
Exactly. And just to round out those impressive annual financials for 24, their net income climbed to $1.41 billion. That's up from $1.29 billion the year before.
Right.
And basic EPS, that's earnings per share, a key measure for you investors, hit $7.35.
So what this tells us, if we connect it to the bigger picture, is that Garmin is a company capable of both, significant market expansion and highly efficient operations. The substantial increase in net income and EPS really demonstrates their ability to convert that top-line growth into tangible shareholder value, even as they ramp up product volume.
Yeah.
It suggests a robust and scalable business model.
The overall financials for 2024 paint a very robust picture, but let's zoom in a bit, segment by segment, and see where that growth is truly coming from. It's fascinating to see how diverse their revenue streams are.
Yeah, definitely.
Outdoor, for instance, really led the pack. It represented the largest portion of their revenue mix at 31% in 2024.
Wow, almost a third.
Yeah, with revenue jumping significantly to almost $2 billion and operating income soaring past $700 million. This was primarily fueled by their adventure watches.
The Phoenix line and others like it.
Exactly. Those just continue to gain traction and, frankly, a lot of loyalty among users.
And the fitness segment also showed incredible momentum, right?
Absolutely. Strong demand for their wearables drove substantial revenue growth there, reaching nearly $1.8 billion. And impressively, they more than doubled their operating income.
Doubled.
Yeah, more than doubled to over $480 million.
That's a strong indicator of both deep market acceptance and, highly efficient cost management in that category. It's a segment where they are truly differentiating themselves.
Then you've got Marine. Revenue increased there to just over $1 billion, operating income at $236 million.
Okay.
And the sources tell us a good chunk of that growth came from the acquisition of JL Audio.
Ah, right. The audio integration. That makes sense.
Yeah, clearly added a lot of value. Over in aviation, revenue grew to nearly $880 million, mainly from their OEM product categories.
So supplying directly to aircraft manufacturers.
Correct. That's original equipment manufacturer stuff, like the avionics built into new aircraft. And the segment maintained a strong operating income, too, over $210 million.
Still very profitable.
Definitely. And it's encouraging to see Auto OEM experiencing notable revenue growth. That segment jumped to over $600 million.
And that was mainly the domain controllers.
Yes, increased shipments of their domain controllers, those central brains managing various functions in modern cars, infotainment, advanced safety systems, that sort of thing.
Right.
This improvement pushed their operating loss position down significantly. It's still a loss at negative $38.7 million, but they're clearly moving in the right direction there.
That segment performance really speaks to their core diversification strategy, doesn't it? It's not just one area carrying the load. It's a multifaceted approach. And it's probably worth highlighting the significant industry recognition they received in 2024 as well.
Oh, absolutely.
Garmin was recognized as #1 in customer support for the 21st consecutive year by Professional Pilot and Aviation International News. 21 years.
That's incredible consistency.
And they were also named 2024 Manufacturer of the Year by the National Marine Electronics Association, received the 2024 IBE X Innovation Award, and recognized as the 2024 Most Innovative Marine Company by Soundings Trade Only.
It just shows how consistently they deliver on quality and user satisfaction across these really diverse product lines.
It really does.
And kind of a nice historical note, their founders, Gary Burrell and Dr. Min Kao, were inducted into the National Aviation Hall of Fame. That marked Garmin's 35th year operation.
Wow. What a legacy they've built. Really something.
So we've seen how strong 2024 was, but what's truly compelling, I think, is that Garmin didn't just maintain that momentum into Q2 2025.
They accelerated it.
They accelerated it across the board, which really speaks volumes about their strategy execution. They achieved double-digit revenue growth in all 5 segments again.
All 5, that's impressive.
Yeah. And fitness, once again, led the way with an outstanding 41% growth year over year for the quarter.
41%. Okay. So this strong performance isn't just a flash in the pan. It's looking like a consistent trend across their diversified portfolio.
Seems that way.
And we also saw that geographic strength continue, didn't we? All 3 key regions saw double-digit growth.
That's right. EMEA was up 25%, the Americas up 19%, and APAC up 16%.
It really underlines the global demand for their specialized products, even in what you might call a challenging economic climate.
Agreed. Now, while revenue was surging, operating expenses did increase. They were up by $74 million, or 14% in Q2 compared to the prior year.
Okay, where'd that increase come from, mainly?
Well, a significant portion, about $34 million, went into research and development, R&D. And selling, general, and administrative expenses, or SG&A, rose by about $40 million.
That increase in R&D is a critical point, I think. It signals their ongoing commitment to innovation, which, as we'll probably get into more, is a core driver of their growth.
Definitely.
They're investing in the future, not just, resting on their laurels from past successes. It's a strategic spend that underpins their ability to differentiate.
So what does this all mean for their growth drivers? I mean, a lot of it comes down to that smart innovation and diversification, allowing them to carve out these strong niche markets.
Right.
In fitness wearables, for example, even though Garmin is described as maybe a smaller market share player overall.
Compared to the really big names, yeah.
Compared to the big names, they are clearly gaining share in what the analysts call a relatively stable wearable market.
And that's driven by their strategy, right? That high levels of innovation and differentiation in their product lines.
Precisely. They aren't trying to be just another generic smartwatch. They're making these highly specialized tools designed for specific athletic pursuits, running, cycling, triathlons.
Right, for people who are serious about their activity. And that specialized approach is evident across their portfolio. Adventure watches, for example, are cited as a primary driver behind the outdoor segment's robust performance.
Those watches are key.
Yeah, these aren't just fashion accessories. They're purpose-built for things like hiking, climbing, exploration, offering features that, frankly, standard smartwatches just can't match. Battery life, GPS accuracy, durability.
All crucial for those users. And in aviation, they're truly innovating, not just making small improvements. They've launched game-changing new products and features.
Like what?
Like the G5000 PRIME integrated flight deck for Part 25 aircraft. Those are the larger business and commercial jets.
Okay, big systems.
Yeah, and they also enhance connectivity by adding FAA datacom to the GTN 750i's navigator. That extends modern digital communications, like getting air traffic control clearances digitally, to the aftermarket for existing aircraft.
That's huge for retrofitting older planes. Their pace of innovation, especially in aviation, is just remarkable. What's their secret there? How do they consistently churn out these game-changing products?
That's a fantastic question, and it really seems to come down to a few core things. But one of the most compelling examples lately is their approach to something called smart charts.
Smart charts.
Yeah, it's described as a disruptive innovation in aviation. It's designed to make instrument approaches much more intuitive. How? By showing the pilot's actual position on context-specific geo-referenced charts right on the display.
Ah, so you see yourself on the approach plate, basically.
Exactly, which is a significant step towards improving pilot safety and efficiency, making complex procedures much, much clearer.
That sounds incredibly useful. Meanwhile, over at Auto OEM, their growth is clearly driven by those increased shipments of domain controllers we mentioned.
Right, becoming more common in new cars.
And the company is busy validating global production lines for entirely new device designs. They're targeting readiness for these by the end of 2026.
So, still a ways off, but progress.
Yeah, this isn't a small tweak. It's a major undertaking involving extensive testing and deep collaboration with car makers. It takes time.
And this all feeds directly into their pricing strategy, which I find quite interesting. Garmin really emphasizes that their growth isn't coming from just, jacking up prices.
Slapping on significant price hikes on existing stuff.
Right, which is crucial in today's environment. Instead, their strategy involves introducing new product lines with new features that can command a higher price point because they do more for the customer.
So innovation justifies the price.
Exactly. It's like a 1-2 punch approach, promoting existing products for value while simultaneously offering these innovative new products at higher price points. They're effectively creating new value propositions rather than just increasing the cost of the old tech.
That dual approach seems incredibly effective. It lets them stay relevant in established markets while capturing that premium value in emerging categories or with new features.
Makes sense. Now, looking ahead, building for the future, Garmin has some significant strategic developments underway. They recently announced the acquisition of MYLAPS.
Ah, yes, MYLAPS, big name in timing.
Huge name. A global market leader in timing. We're talking notable customers like the Boston Marathon, Ironman, Formula One.
That's quite a roster. So what's the strategic play here?
Well, what's truly strategic here is the potential synergy. They aim to merge Garmin's device data, from watches, bike computers with MYLAPS official timing and race management technology.
Okay, I see. So connecting the training data with the actual race day results.
Precisely. To provide a comprehensive training to race day experience for their customers. This could significantly expand Garmin's addressable market in the whole sports and performance sector.
And importantly, you mentioned this acquisition is fully included in their guidance.
That's what they said, meaning they've already factored its expected impact into their financial projections for the year.
Good to know. What else is developing strategically?
Well, they also have a robust subscription platform and Connect ecosystem that contributes to their recurring revenue stream.
Ah, the services side.
Yeah. Garmin offers ongoing services tied to products like map updates and server-based traffic services for their PNDs, their personal navigation devices.
It's still a thing.
That's still a thing. Then there are aviation databases, other navigation and communication services, mobile apps like the Garmin Golf app, and even extended warranties, all offered as subscriptions.
This recurring revenue model, which they recognize over time, typically, 1 month to 3 years?
Yeah.
That contributes significantly to revenue diversification and stability, doesn't it?
Definitely.
It's not just about selling a device once. It's about building an ongoing relationship with the customer through these valuable, evolving services. It shifts them from just pure hardware sales towards a more integrated, service-oriented model.
And something that's really a core competency for Garmin, maybe a distinguishing factor in the tech world today, is their vertically integrated manufacturing.
Right, they make a lot of their own stuff.
They really do. They own and operate facilities across Taiwan, the U.S., the Netherlands, Poland, China. That's not common for many tech companies who tend to outsource heavily.
And that's an important point. Why does that vertical integration matter so much for Garmin, do you think?
Well, the sources suggest it provides distinct advantages in product cost, quality, and time to market. By controlling more of the production process, they can do rapid prototyping more easily, achieve higher efficiency, and theoretically lower costs.
And it probably helps with managing those diverse product lines, too.
Exactly. It allows them to leverage manufacturing resources across high, mid, and low volume products, which is a huge advantage for their kind of specialized portfolio. It's a differentiator that's genuinely hard for competitors to replicate quickly.
And this all ties back to their strong commitment to new product innovation and R&D, right?
Absolutely. They're constantly increasing their investment in innovative design and development across all segments. We saw those R&D costs rising in the last quarter. And that investment aims to create unique, differentiated products that competitors might just overlook, with the goal, as they put it, of being a class leader in their chosen niches.
Makes sense. Lead where you can dominate.
Okay, so that's the good news. But of course, every company, even one performing this well, faces potential headwinds. When we look at the risks and market outlook for Garmin, geopolitical and supply chain risks are definitely on the radar.
Especially with Taiwan.
Exactly. Their principal manufacturing facilities are concentrated in Taiwan, which, as the reports state, exposes them to unique economic and political risks, particularly related to PRC-Taiwan relations. That's a significant geographic concentration.
Yeah, no kidding. What's also concerning is their reliance on third-party suppliers for key components, things like semiconductors, memory chips.
Always a vulnerability.
And some are even sole-source suppliers. That introduces inherent supply and pricing risks. Now, Garmin says they mitigate this by holding safety stock and believe their vertical integration helps them deploy new designs quickly if needed.
So they have some flexibility.
Some flexibility, maybe minimize disadvantage compared to competitors during disruptions. But it's still a risk. It's a calculated risk management approach. But the risk remains.
Then there's market competition and maturation. I mean, they operate in highly competitive markets across all segments. Some larger competitors just have vastly greater resources.
True.
And there's also the potential for maturation or contraction of the market for wearable devices. Now, Garmin currently reports gaining share in a relatively stable market, as we discussed.
Right. They seem optimistic for now.
But the threat of a stagnating overall market is always there for wearables.
This raises an important question then. How do they navigate broader macroeconomic headwinds? Things like currency fluctuations.
Yeah, that's a big one. Garmin is exposed to fluctuations in foreign currency exchange rates. The US dollar versus the Taiwan dollar, the euro, the Polish zloty, the Australian dollar.
A truly global footprint.
It is.
Yeah.
And in 2024, for example, they actually incurred a net foreign currency loss of about $20.6 million just due to the strengthening US dollar. And just to give you a sense of scale, the reports mention that hypothetical 10% adverse shifts in exchange rates could impact their income before taxes by approximately $100 million.
Wow, that's significant exposure. And then there's inflation impacting costs and just general economic conditions, higher interest rates, unemployment, recession fears, all potentially affecting demand for what are often discretionary purchases.
Absolutely. And beyond the big picture stuff, there are other potential risks, too. Their dependence on continued new product development. They have to keep innovating.
The pipeline needs to stay full.
Exactly. Then there's the ever-present threat of IT system failures, network disruptions, cybersecurity breaches, intellectual property challenges, and litigation are always possibilities.
Compliance costs, too.
Right. Compliance with evolving global laws, particularly around data protection and environmental regulations. Plus, their core reliance on GPS and other satellite systems makes them vulnerable to external interference or, policy changes, like potential 5G interference in certain bands affecting GPS signals.
It's a complex landscape out there for any global tech company, for sure.
No doubt.
That's a pretty comprehensive overview of the challenges. Now, if we connect this to the bigger picture, it seems management has a pretty grounded view of these dynamics, judging by their comments in the analyst Q&A session.
What did they say?
Well, on channel management and demand, for instance, management stated that channel fill from new products wasn't a significant factor in their Q2 outperformance.
So not just stuffing the channel.
Apparently not. Nor do they see signs of pull-forward demand or stockpiling by retailers. They said they actively monitor sell-in versus sell-out data and have credit limits in place. It suggests a disciplined approach to inventory management.
That's certainly reassuring to hear, that disciplined approach from management. But, given the broader economic uncertainty, how much comfort does that really provide investors? Are there still maybe unseen headwinds they might be facing that aren't showing up yet in current demand figures?
That's fair. But management's confidence seems rooted in their strategy of innovation. They sound confident about gaining market share in wearables, despite being a smaller player overall.
Attributing it to that differentiation.
Exactly. Attributing success directly to that innovation and differentiation we've talked about. They seem genuinely optimistic about future opportunities across all segments, emphasizing their ability to create unique products where competitors, as they put it, haven't even thought of.
Finding those overlooked niches.
Their view seems to be that by leading with differentiated tech, they can better navigate those broader market shifts.
Okay. And what about the auto OEM front? Any updates there?
Yeah, they mentioned making solid progress. They're in the process of validating production lines for a new device and design for a specific car maker. Readiness is expected by late 2026.
Late 2026. So that underscores the long lead times in that industry.
Absolutely. It isn't a quick flip. It involves extensive testing and deep collaboration.
And finally, what about working capital and cash flow?
Management indicated that receivables growth is primarily related to the sales growth itself, which makes sense. And that working capital is, quote, pretty well on plan.
Okay.
They anticipate full year 2025 free cash flow to be around $1.2 billion. They describe this as very similar to what it was last year.
Interesting. Now, I thought the 2024 report showed $1.4 billion in free cash flow.
That's right, it did. So when they say very similar, it might signal that management's perspective factors in, perhaps, increased operating earnings being offset by strategic investments, maybe like increased inventory to support growth or hedge supply risks.
Keeping things on plan, in their view, even with a slight numerical difference.
Exactly. It could be seen as a testament to navigating the current environment while still investing heavily for the future, managing those trade-offs.
Right. So summing up, Garmin's performance in Q2 2025 and throughout 2024 really shows a company firing on all cylinders.
Certainly seems that way. Fitness wearables, adventure devices, aviation systems, all growing strongly. Margins are expanding.
And new acquisitions like MYLAPS point toward a future in these connected performance platforms.
Yeah, building out that ecosystem. Risks definitely remain. We talked about geopolitical exposure, the maturing wearable market maybe.
Yeah, those are real.
But Garmin's diversified portfolio and those deep R&D investments, that vertical integration, they seem to provide a basis for long-term confidence.
It really makes you wonder, doesn't it, how a company so deeply rooted in specialized high-performance technology manages to consistently innovate and expand. They effectively carve out these niches that might be too complex or maybe just too low volume for the larger, more generalized tech giants to really chase aggressively.
Perhaps that vertical integration really is the secret sauce, like you suggested earlier, allowing them to remain agile and cost-effective in areas where others just can't compete in the same way.
Could be. Definitely something to watch. Thanks for listening to Know What You Are Investing.
What they do.
How they grow.
Why it matters.
See you next time.
Garmin may not be the flashiest name in tech, but behind the scenes, they're executing with precision. Segment by segment, product by product, Garmin is turning R&D into results and building platforms that go beyond devices. With raised guidance and global growth, the momentum is real. Thanks for tuning in to Know What You Are Investing, where we help you understand what they do, how they grow, why it matters. Until next time, keep learning, keep investing.